Imagine earning a degree that prepares you with real skills for the real world. Capella University's programs teach skills relevant to your career so you can apply what you learn right away. Learn how Capella can make a difference in your life at capella.edu.
You're listening to a Mint podcast brought to you by HT Smartcast.
The hike in capital gains tax rates in the recent budget has impacted almost all investment products. Some have been impacted more, some have been impacted less. Among them are PMS products. In today's episode of Why Not Mint Money, we are joined by Anthony Heredia, who is the CEO of Mahindra Manulife Mutual Fund, to tell us more about how PMS investors can find more tax-efficient alternatives in the mutual fund space and how focused funds can be an alternative for PMS investors.
Welcome to Why Not Mint Money, a personal finance podcast where we help you understand basic money concepts and share strategies for you to build your wealth. So let's get started with your money journey.
Hi Anthony, welcome to the latest episode of Why Not Mint Money. It's really great to have you here.
Thank you, Josh. Pleasure always.
Right. So Anthony, to kickstart this episode, we wanted to ask you first and foremost that there have been a lot of tax changes, especially on the long-term capital gains and short-term capital gains, and especially PMSs, which had a lot of churn. They seem to have been the worst affected because of these changes. In that situation, do you think there are alternates within the mutual fund space, which clearly seems to be now a more tax efficient vehicle, even more so than what it was before?
So just, I'd first say that end of the day, an investment call should be first made on the merit of the investment proposition and the objective, right? The idea is you first make money, then you worry about the tax. But that being said, in terms of the format of how the tax incidence occurs, if it starts to influence the way investment decision gets made, then it becomes a complex exercise, right? And in the recent budget, the fact that short-term capital gains tax is now at 20% and long-term at 12.5% means that any churn in the portfolio, if it is taxed at either the fund level or the individual investor level, becomes suboptimal, because to that extent you have lesser money to have invested in the portfolio. That's point number one. Point number two, having said that, I think PMS and to some degree certain types of AIF products create the possibility of having more concentrated portfolios, right? That's how they are differentiated from the plain vanilla diversified fund. And I would therefore say that within the mutual fund space of different types of equity funds, I would say post these changes or even before these changes itself, the focused fund category is something that anyways deserved merit, and probably after the recent changes deserves even more attention.
That's a great point where we can maybe segue into what focus funds are all about. So Anthony, for the benefit of our listeners, can you tell us what focus funds really are and how do they work?
Yeah, so just before that, I'll just take a step back, right? SEBI
Sure.
created these product categories a few years ago. And in the diversified space, you have varying types. You have large cap, you have multi-cap, flexi-cap, etc. They also introduced a category called focused, where they basically said that you have to put your best ideas into a portfolio, but those ideas can't exceed 30. So you're kept at a maximum of 30 stocks within the portfolio. So in some sense, as the word focused itself indicates, it will tend to be a higher conviction portfolio, probably filled with the best ideas that fund manager has to bear, because they can't buy the 31st or the 32nd name. And over time, you would expect that such portfolios, if the fund manager's calls are broadly more right than wrong, will outperform most typical diversified funds. I mean, we've certainly seen that in our context. Interestingly, I remember a statistic that I had observed when we were doing some number crunching, that focused funds by and large tend to have a reasonable exposure to large caps, and they all seem to have by and large outperformed the benchmark. Yet at the same time, the contradiction is if you keep reading that large cap funds have struggled to beat their benchmarks, right?
Right.
While the focus funds that have a large amount of large caps have outperformed their benchmarks, which have been steeper because it's the Nifty 500 versus an NSE 50. I have to believe that has got to do with the fact that there is a forced conviction that is being played out as part of the portfolio strategy.
From a mutual fund investor's perspective, can focus funds be slightly more risky because there are more concentrated bets?
Yes, it is. It is theoretically more risky, but I would argue that if I'm giving money to an active manager to manage, right? So I'm paying fees so that you actively manage the portfolio. I think the focus fund is the biggest example where the fund manager will be active just by definition of the fund itself. Right. Now, to me, buying a stock that you have to have higher conviction, therefore deserves higher research going in, a lot more thought, to some ways practically reduces the risk as well, right? Because at the end of the day, unlike any normal fund, what is the typical day in a fund manager's life? It's about sometimes reducing weights and increasing weights based on your view on how stocks and sectors are evolving. Right. And a focus fund, sometimes that's not you can't do that, right? Because you've got to have 30 stocks. Yeah. So if you want to bring a new idea in, you need to drop an idea completely. So you tend to have very deep thought before you act on either side. And to my mind, that compensates for the theoretically higher risk because it's a concentrated portfolio.
So what kind of weights that a typical focus fund would have to each individual stock idea?
So my experience, I've seen that very rarely do you have stocks with weights less than 2%.
Okay.
2.5% is typically the bare minimum weight you'd have. And you often may find stocks which are 7-8%. But I also have seen that those stocks tend to be either large caps when you're buying them, or they are stocks that you've been fortunate enough to buy when they were small and mid, and they have obviously become multi-baggers. So therefore, a 3% weight has now become 6% or 7%. But I would say the broad range has been 2.5% on the downside. To about 7.5% on the upside.
Right. And Anthony, given the fact that focus funds have an inbuilt limit of 30 stocks and no more, is diversification also well taken care of, or that's something that's lacking because the limit is only 30 stocks?
No, I've never seen that in my experience to be an inhibition, because 30 stocks gives you enough room to play with the two standard diversification templates, right? Template number one is how is it between large, mid and small companies, right? And template number two is how is it represented in terms of sectors, banking, financial services, technology, consumer and stuff like that. Right. I have never seen it to be a limiter.
Okay.
Yes, it obviously means that there will be certain sectors that may be completely absent because there's no stock in that sector represented. But by and large, I have never seen focus funds to be a worry because they are not diversified enough.
Anthony, and when it comes to picking and choosing among the focus funds that are available in the industry, how should investors go about it? Is it like choosing any other? Are there some other ratios that an investor should look for when looking out for such funds?
So I would say I normally, when I look at a focus fund, unlike sometimes other funds, I tend to look beyond the numbers. Reason I say that is because focused, therefore 30 stocks means that I think the fund manager's experience and past track record plays a very important role, right? So I would firstly go with a fund manager that has experience through multiple market cycles, because at the end of the day, it's an evolving market. You want someone who's seen a bull and bear market, etc., etc. So it's not just the last 3 years track record or the last 5 years track record. That's point number one. Point number two, I would go into not the performance, but I would go and take a look at how the stock selection and the holding patterns of the fund have been. Because by logic, if a focus fund is supposed to be high conviction, and I find that there is a focus fund where the turnover is actually high, then it's kind of counterproductive, right? So I want to see a focus fund where the portfolio turnover is perhaps a little lesser. The third is that because the opportunity set in 30 companies can emerge from virtually anywhere, which means either small, mid or large, or either financial services or industrials, etc. I want to see a fair representation of different types of companies.
Okay.
So I wouldn't be happy with a entirely small cap focused fund. Conversely, I wouldn't be happy with an entirely large cap focused fund. I'd like to see a focused fund that's broadly run in a flexi cap format. So to summarize, run it in a flexi cap format, run by somebody who has long-term credentials of having managed money across cycles, right? And shows the ability to have high conviction at the point of creating the portfolio. So turnovers are low. Those would be my 3 primary criteria.
Sure. Just to clarify here, a high churn rate in a mutual fund, in the sense in a focused fund, will not really be a tax incident, as is the case with the PMS, right?
It's not. So that of course is obviously a great benefit with any equity fund, including a focused fund, that if you buy into a stock idea and you discover 6 or 9 months later through a variety, there will always be circumstances, right? There can be policy change, there can be external environment change, etc., etc. I'm not saying that every stock is a fill it, shut it, and live with it forever. And obviously the tax incidence means you can afford to make those calls and exit if necessary. But if I am expecting a high conviction portfolio, I would not want a portfolio that churns itself out, frankly, every year.
Sure.
Because to my mind, high convictions need to be multi-year. It doesn't mean that I want to not see stocks changing for 3 or 4 years. What I mean is ideally a turnover of 50% or lesser is what I would typically look at.
Thanks, Anthony, for all the insights. I'm sure this conversation will help a lot to our listeners who are tuning in today, especially after the changes that have happened in the budget as far as taxes are concerned. Thank you. Thank you, listeners, for joining us today. If you liked this episode and would like to hear 2 more such interesting conversations, do log into our channel, Why Not Mint Money, on Spotify as well as other platforms, where you will find me omnipresent. Also, if you have any new ideas or suggestions, you can DM me on Twitter. My Twitter handle is @Jash Kriplani, that is JASHKRIPLANI, or y'all can always mail to us at mintmoney@livemint.com.
To stay updated on this podcast, follow us at HT Smartcast on all the major social media platforms. To listen to more such podcasts, log on to www.htsmartcast.com.
Earning your degree online doesn't mean you have to go about it alone. At Capella University, we're here to support you when you're ready. From enrollment counselors who get to know you and your goals, to academic coaches who can help you form a plan to stay on track. We care about your success and are dedicated to helping you pursue your goals. Going back to school is a big step, but having support at every step of your academic journey can make a big difference. Imagine your future differently at capella.edu.